Hello and welcome to episode 45 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria.
And my name is Tamanna Suria.
What we will cover today on the podcast is just a small part of what happened in the special situations world last week. For daily updates and alerts on special situations, as well as access to tools to help you identify opportunities, such as our merger arbitrage tool, check out insidearbitrage.com. Also, please take a moment to like and subscribe to this podcast on whatever platform you may be listening on.
We are continuing with our new format by focusing on 4 key stories, including a new higher bid for the narcolepsy-focused drug company Avadel, a large $1.5 billion stock buyback announcement by a grocery delivery company Instacart, several interesting insider purchases now that company executives are outside their earnings-related quiet periods, and an activist who's trying to convince a pain management company, Pacira BioSciences, to put itself up for sale. Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of the podcast for more detail. We'll begin our episode today with a look at deals in the works. It was reported at the start of this week that Clearwater Analytics, an investment and accounting software company, is exploring a potential sale after receiving takeover interest. A few days later, it was revealed that Warburg Pincus and Permira were the two firms interested in Clearwater, which makes sense considering that these two firms were the ones to take Clearwater public in 2021 initially. Clearwater's stock is down about 24% since its IPO, and down about 30% year to date, especially after their acquisition of Enfusion at the start of the year. Enfusion was a company focused on creating software for investment management and hedge funds specifically, whereas Clearwater was a lot broader, focused on automated investment accounting, performance, compliance, and risk reporting. So the Enfusion acquisition very much represented a move to gain access to other markets and start a strategy shift. Perhaps the thesis here is that Clearwater would perform much better under private stewardship, and it is rumored that a deal would come to fruition in the next few weeks or so.
That's interesting. But there's even more interesting stuff going on with current deals that have already been inked. One of the longest running acquisitions in recent months was a $627 million acquisition of Surmodics by the private equity firm GTCR that manages upwards of $40 billion of capital. Surmodics is a medical coatings company that makes these coatings for interventional devices and drug delivery solutions that can control the release of drugs from a timeline of minutes to years. I was quite surprised to read that they could release drugs over a period of years. Anyways, the deal was trading at a massive spread or potential profit as high as 63% at the start of this month because GTCR had a portfolio company called BioCoat that also makes medical coatings. And the FTC was concerned about too much concentration in this niche area if GTCR was allowed to proceed and acquire Surmodics. Surmodics is the number 1 producer of coatings, and BioCoat is the number 2 producer. So I can see why the FTC was concerned. The FTC sued to block the merger in March. However, last week, a court denied a request by the FTC and certain state regulators to issue a preliminary injunction that would block the merger. In response, Surmodics saw its stock jump up 50% in a single day and then continued trending higher. The spread on the deal now is just 3.34%. Just looking at this whole situation, this year has been a bonanza for special situations investors, especially the ones that have been focused on the merger arbitrage strategy.
Absolutely, and the bonanza extends to bidding wars as well, because one of our favorite biotech companies to talk about is Avadel, which is a pharmaceutical company focused on treating narcolepsy and other sleep disorders. We've talked about this company many times on this podcast before, and actually featured the business as a spotlight idea for our monthly newsletters on Inside Arbitrage, after we saw some very opportunistic insider buying. Now, as a quick recap, Avadel produces a sodium oxybate drug meant to treat narcolepsy and has created significant competition for the pharmaceutical giant Jazz Pharmaceuticals. Well before Avadel received approval under the Orphan Drug Act to treat narcolepsy with their drug, Lumryz, Jazz Pharmaceuticals had created a very similar drug to treat the same condition. According to a lawsuit filed by Jazz against the FDA, both drugs were essentially the same. However, the key difference lies in the drug's dosage. Avadel's drug is single dose, meaning patients can just take the medication and head to bed for the night. Jazz's drug, on the other hand, is split dose, and patients must wake up in the middle of the night to take their second dose. The dosage difference is what the FDA used to deem Avadel's drug to be clinically superior, and thus Avadel was allowed to enter the narcolepsy treatment market and has been steadily growing its market share. Jazz's two drugs to treat narcolepsy at one point generated $2 billion in annual sales, so it's understandable that they would want to protect this market and the niche they had carved out for themselves.
So how did the market react to this development?
No, you'd expect the market to bid up Avadel's stock price quite rapidly, especially considering that they had the superior drug and a clear path to profitability and revenue generation. But the opposite happened. It turned out that adoption and prescription of Avadel's drug was slightly slower than expected, and then the market beat the stock down hard. By the time we first wrote about the insider purchases at Avadel, the company's stock price was down over 50%. However, we continued to see insiders purchase shares, and given the clinical superiority and steady adoption rates of the drug, we eventually added the company to our portfolio. The thesis ended up playing out faster than we expected, and in a different way than we expected. At the end of October, we were pleasantly surprised to find out that Alkermes, a neuroscience-focused biotech, had agreed to acquire Avadel for a closing value of $2.1 billion. The deal was structured such that Avadel shareholders received $18.50 per share in cash, with an additional CVR worth $1.50 per share, also payable in cash, should Avadel attain FDA approval for Lumryz, their existing narcolepsy drug. But this approval would be for idiopathic hypersomnia, which is a condition that causes excessive daytime sleepiness, very similar to narcolepsy.
Yeah, with that deal announcement, we ended up more than doubling our money on this investment. Was that the end of the whole story?
So yes, this is where things get even more interesting. This week, the Danish drug maker Lundbeck offered to acquire Avadel for up to $23 per share, as compared to the existing deal that Avadel has with Alkermes for up to $20 per share. Lundbeck's proposal included a $21 per share in cash offer, plus up to an additional $2 per share, contingent on future U.S. sales milestones for Avadel's sleep disorder drug, Lumryz, and its investigational therapy, Valiloxybate. Now, Avadel's board said that Lundbeck offer could reasonably lead to a superior proposal under its deal with Alkermes. But in general, sales-based milestones are riskier and harder to achieve when compared to regulatory milestones.
Yeah, in some sense, they are both difficult, but you're right. The sales-based milestones are significantly harder to reach. What do you think is the probability of the CVR paying out?
Well, it has to do with the CVR conditions themselves. The Lundbeck CVR consists of $1 per share, contingent upon Lumryz and Valiloxybate, collectively reaching a total annual net sales in the US of at least $450 million in any year by the end of 2027. And then another $1 per share contingent upon the two drugs collectively reaching at least $700 million in any year by the end of 2030. Based on data as of June 30th, 2025, about 3,100 patients were taking Lumryz, and the drug's net revenue for 2025 is expected to be between $265 and $275 million. Avadel obtained the license for Valiloxybate from XW Pharma in September, so no revenue estimates are available for that drug just yet. The $450 million milestone looks somewhat achievable, especially if adoption rates continue to increase, and Lumryz is able to penetrate the narcolepsy market further, as well as the idiopathic hypersomnia market. However, that $700 million deal might be a little bit harder to achieve, but then again, consider that Jazz was able to reach $2 billion in total market sales for that narcolepsy drugs. So it might be more possible for Avadel at the end of the day.
Yeah, I mean, the Lundbeck offer is more than the prior offer with the CVR combined, just the cash portion of the Lundbeck offer. Right? So the CVR is just a free lottery ticket in some sense. So let's see if the board does call it a superior proposal. They end up paying the termination fee and getting out of the previous deal. or if Alkermes comes back with a higher offer for Avadel. I sold the stock in the model portfolio after the first deal was announced because we don't track CVRs in a model portfolio. I retained it in my personal portfolio, figuring I'll just let the deal close, end up with a CVR that may or may not pay out in the future, and this was a pleasant surprise. Switching gears a little bit to yet another battle, which just happened and concluded last week. It was a battle between Novo Nordisk and Pfizer for the obesity drug Metsera, which finally came to an end after shareholders approved the significantly higher offer from Pfizer, and the deal closed on the same day of the shareholder vote. The final deal price was $65.60 per share in cash and a contingent value right, or CVR, of $20.65 based on three different milestones being met. Metsera was trading a little over $70 per share before the deal closed, implying that the ARBs were assigning a value of about $4 to $5 for the CVR. Assuming that the shareholder vote would go through and there would be no other issues because regulatory approval was already in place. A few days before the deal closed, I heard from a friend and a subscriber that the $70 put options, both for the November and December expiry, were trading for about $4.20 to about $4.40 per option.
This seems highly unusual, and it almost feels like free money in some sense, assuming that the stock remained above $70 per share before closing.
Yeah, this was interesting, and I was trying to figure it out. And so I discussed it with a fund manager on one of our quarterly check-ins, and we were both trying to understand, why does this opportunity exist? As you know, there are no free lunches in the market. And actually, we found the answer in an OCC memo issued on November 10th. The OCC, or the Options Clearing Corporation, is the world's largest equity derivatives clearing organization, and their memos usually lay out how options will be settled in certain unique or special situations. The answer to that $4.40 option price lay in a sentence in the memo that said, and I'm quoting this verbatim, the adjusted MTSR option deliverable will not include the non-transferable CVRs. Essentially, if you sold the $70 put options, you ended up with the stock at $65.60 per share and without the CVR. Hence that $4.40 premium. Depending on how much the options was sold for, it could be a break-even trade or a trade at a tiny loss. So this was a good lesson on always checking the OCC guidance before acting on situations like these with options. Thankfully, it wasn't an expensive lesson for my friend.
Now, there seems to be no end to the list of biotech deals that we cover on this podcast. At some point, we should just turn this into a biotech M&A podcast, because one of the largest deals announced this week was the acquisition of Cidara Therapeutics by Merck for a closing value of $9.2 billion. Under the terms of the agreement, Cidara shareholders will receive $221.50 per share in cash. The acquisition represents Merck's second M&A transaction of the year, following its $10 billion acquisition of Verona Pharma, as the company works to replace some key revenue-generating drugs ahead of patent expiration in 2028. What was most shocking about this deal was the premium paid, a whopping 108.98%, which caused Cidara's stock to skyrocket over 100% in a single day after the deal was announced. Just a few months ago, we saw a tiny insider purchase by a director at the company. Since then, the stock is up over 900%. Existing shareholders of Cidara must be extremely pleased with the way that things have played out. If only we had used the Avadel playbook here.
Switching gears to stock buybacks, the last couple of years have been a challenging period for oil and gas companies, and it was surprising to see that in this environment, an oil and gas exploration and production company called Infinity Natural Resources decided to go public in January at $20 per share. As could be expected, the stock went on to decline most of this year and bottomed close to $11 earlier this month. The stock rebounded nearly 20% from those levels after the company announced third quarter 2025 results and announced a $75 million stock buyback that represented more than 42% of this microcap company's market cap at announcement. We would have normally skipped talking about this announcement, The sheer size of the buyback in relation to the market cap jumped out at us. The company grew its production by 39% in Q3, including a 70% jump in natural gas production. And they generated net income of $40 million and adjusted EBITDA X of $60 million.
So we all know Buffett isn't a fan of EBITDA because it already excludes so many factors. So I'm curious, what is EBITDA X? Is it similar to EBITDAR where you're excluding rent and restructuring costs as well?
That's the one I was trying to recollect as I was preparing for this. I was like, there was this one other variation of EBITDA that we have seen before. You're right, it was
Mm-hmm.
EBITDA R. So let's talk about this EBITDA X. So this whole EBITDA X reminds me of WeWork's community adjusted EBITDA, which investors didn't fall for when the company tried to go public through a traditional IPO. And then eventually they went public through a SPAC and went bankrupt. Let's get back to EBITDA X. First, there used to be EBITDA, which excluded interest, taxes, depreciation, and so on and so forth. And then there was adjusted EBITDA, which excluded other one-time charges. Now we have EBITDA X, which in this case exclude depletion of their oil wells, gains or losses from derivative instruments, which many of these companies use to hedge the price of oil and gas, non-cash compensation expenses, and even more. So all the more reason to just focus on free cash flow and keep an eye out for large, unusual one-time gains or losses, as we saw with our portfolio company CoreMedix that benefited from a large one-time tax-related gain. The language learning app Duolingo, which I use all the time, also benefited significantly from a very large one-time tax-related gain where net income jumped from 91 cents per share in the second quarter of 2025 to $5.95 per share in the third quarter of 2025. So given such a large jump that was tax related, I get it. You can make those one-time adjustments. But unfortunately, with many companies that like to report adjusted EBITDA and so on and so forth, those one-time adjustments happen all the time. Getting back to Infinity Natural Resources, it is good to see that they generated 187 million in operating cash flow in the first 9 months of this year. But as is often the case with oil and gas companies, CapEx outstripped operating cash flow, leading to negative free cash flow for the year. So tiny company, very large buyback. They're clearly making some money, but as is often the case, they're going drill, baby, drill, and there are no free cash flows to be had for the investors. Now, the other buyback that was interesting this week was the $1.5 billion share repurchase announced by the grocery delivery company Instacart, that for some reason continues to call itself Maple Bear and does business as Instacart. They have a nice ticker symbol called CART that has nothing to do with bears or maple syrup. So I still can't wrap my head around this whole Maple Bear thing. Anyways, getting back to the buyback announcement, they announced a 1.5 billion buyback that represented 15% of their market cap at announcement. The company went public at $30 per share in September 2023 and currently trades at $41 and change. So not up a whole lot over the last 2 years. Fiji Sumo, who was previously at Meta for a decade, used to be Instacart's CEO for 4 years before leaving recently to join OpenAI as its CEO of applications in August. The new CEO, Chris Rogers, used to be Instacart's chief business officer, so it was an internal promotion in some sense, and he used to work at Apple for more than a decade, but in Toronto.
So, how does Instacart compare and contrast to other tech and software businesses, where it's all about revenue growth and GAAP profits are scarce or non existent at all?
Yeah, they're actually quite different in that sense. They have gross margins that are similar to a lot of these software businesses, but it's interesting to see that Instacart has been growing revenue between 9 and 11% in each of the last 4 quarters, and earnings are actually expanding. So these are GAAP earnings, right? They're not adjusted random earnings, if you will. They reported earnings per share of 51 cents in the third quarter of 2025, which is a penny more than analysts had expected, and was quite strong considering that it wasn't the holiday quarter, which is seasonally their strongest quarter. Given Fiji Sumo's background in advertising, it is not surprising to see that Instacart has an advertising business. But what was more interesting to hear is that the company is now positioning itself as an enterprise grocery software business that helps retailers with both online and in-store operations. Their storefront technologies, as they call it, now powers the e-commerce sites of more than 350 grocers. This whole pivot reminds me of when Amazon pivoted from being an online bookseller to running the e-commerce operations of companies like Target, and then eventually went one step further by launching AWS.
I wonder how much this pivot might cost for Instacart and if it's going to shape up to be quite expensive.
Yeah, in that context, Instacart is even more interesting. The company is GAAP profitable, the gross margin is approaching 75%, and the net margin is above 14%. If I don't count lease obligations, they have no debt and nearly $1.7 billion of cash on the balance sheet. So it looks like they've already pivoted, they're not eating into their cash, and they remain profitable. The company trades at a forward PE of less than 20, and my favorite valuation metric of EV by free cash flow is just 10.22, making them an ideal acquisition candidate. So this is one that I'm quite interested in, and I'm glad this stock buyback made me take a closer look at the company.
And there seems to be some sort of connection between buybacks and maybe a merger and acquisition down the road, as we'll see later on in this podcast.
Indeed.
Now, moving on to the insider section of this podcast, I've been writing about insider transactions for over 3 years at this point for our Insider Weekends articles on inside arbitrage. And while most weeks we tend to find one company worth spotlighting, there's some weeks where we really have to scrape and search beyond our list of top 5 insider transactions and sales to find a company worth writing about. And there are weeks like this week where there are a number of fascinating insider transactions, and instead of just selecting one to feature, we can't, and we decide to write about them all. For today's podcast, I'll focus on the most interesting transaction, though it's quite hard to decide what that might be. We dive a lot deeper into the company in our Insider Weekends article, and also feature a couple other fascinating transactions, so make sure to check that out as well. So there are times where the company is a little more interesting than the insider who's purchasing shares. And there are times where the insider themselves is a lot more interesting than the company that they are purchasing shares of. Blend Labs falls into the latter category. Founded in 2012, the company is one of the beloved startup unicorns until its IPO in 2021. Unlike many companies going public at the time, the company did go public through a traditional IPO as opposed to a SPAC, but that didn't stop the stock price from falling over 85% since its IPO date.
Wow, that's significant. What does Blend Labs do?
So Blend is a fintech that provides a cloud-based software platform for consumer banking. The company's main product helps financial institutions streamline and digitize the process of originating consumer loans, originally mortgages and home equity products, though they have since expanded to consumer credit products as well. It looks like a little after 4 years after Blend went public, the company has finally managed to achieve that goal of profitability for that most recent quarter. However, the company is still down 33% over the last year, which can't be in part attributed to the declining revenue. Which is why we found the insider purchase at Blend this week especially interesting, given who the insider was. Director Brian Sheth acquired roughly $6.8 million worth of Blend stock this week through Haveli Investments. Haveli Investments is an Austin-based tech-focused PE firm that Mr. Sheth founded and has served as the chief investment officer since September 2022. Mr. Sheth is a billionaire who started his career working at companies such as Bain Capital, Goldman Sachs, and Deutsche Bank.
His name sounds quite familiar. I think we might have seen insider purchases by him before as well. Wasn't he a co-founder of Vista Equity Partners, one of the largest PE firms in the world?
Focus on technology, yeah. So Mr. Sheth joined Vista Equity Partners as a VP in 2000 before becoming president and then being backdated named a co-founder in 2010. Because at the end of the day, he did join the firm when it was founded. He just joined at a slightly lower role. Now, he left the company or the firm in 2020 after Vista Equity Partners CEO and other co-founder, Robert Smith, was charged and prosecuted for tax evasion, but continued to lead the firm. Mr. Sheth was always known as the deal maker at Vista Equity Partners, so to see someone with such experience investing in technology businesses pick up shares of Blend was quite a signal that we decided to pay attention to. That too, looking at the price chart of Blend stock and a list of all inside transactions by Haveli Investments, we can see that Mr. Sheth and his firm only pick up shares of Blend when it hits the $3 floor. Now the stock has been stuck in that $3 range for quite some time, but this might be a longer term play worth exploring. That being said, lending, especially mortgage lending, is a highly cyclical business, and while Blend is creating software for mortgage lenders, any downturn in the industry or broader markets will significantly impact Blend as well. I'm curious to see if this purchase by Mr. Shade is more motivated by the technology platform that Blend operates, or is a fundamental industry thesis that he'll get exposure to via a software platform.
Yeah, I was wondering the same thing. I have a feeling he thinks that, the cyclicality of the mortgage industry might be reaching the bottom and he's positioning himself to benefit from a rebound. But that's big macro call that's hard to kind of determine if it's going to play out or not. But something definitely worth keeping an eye out on.
Fun to pontificate about at the very least.
Indeed.
So we'll move on to the activist section of this podcast. Back in episode 36, we talked about not one, but two activists getting involved with the payments and accounting software company Bill.com. In that episode, we talked about Bill.com being beaten down hard year to date, and its struggles with profitability, although revenue growth had been impressive, and the company also managed to generate fairly stable free cash flows. Starboard was the first activist to get involved, and then nominated 4 directors to the company's board in an effort to unlock shareholder value with their 8.5% stake.
And what was the company's response to this?
So Bill.com responded by pointing to their recently announced $300 million buyback. And I know earlier we talked about buybacks and the connection between returning value to shareholders via buybacks and then a possibility of a merger down the road. But then they had also agreed to cooperate with Starboard. Shortly after that, it was reported that Elliott had also built a roughly 5% stake in the business, though their position had actually predated Starboard going public with their stake. Oddly enough, unlike the typical Elliott playbook, which tends to be a little bit more aggressive, to say the least, the firm declined to comment on the stake when asked about journalists investigating the matter. Now, we talked a lot more about the reasons for the activists getting involved in Bill.com and what the company could have done to turn itself around in that prior episode, episode 36, but Elliott and Starboard had hinted at Bill.com being a possible acquisition or takeover target for larger payments companies, considering the impressive top-line performance and free cash flow generation. It looks like that came to fruition this week, with Bloomberg reporting that Bill Holdings was exploring options, including a potential sale, and was working with a financial advisor to solicit interest from larger industry rivals as well as private equity firms.
Fascinating situations. So many activists involved, a potential deal, something that we really should dig into more. Switching to another activist situation, Doma Perpetual Capital Management, a Miami-based firm that has nearly $300 million in assets, according to their last 13F filing, sent a letter to the board of Pacira BioSciences, urging them to hire bankers and run a sale process for the company. Pacira is a company that focuses on non-opioid pain medications that target post-surgery pain, musculoskeletal pain, and chronic pain. 2 of their drugs, Exparel for post-surgical local pain and Zeretta for osteoarthritis knee pain, have been approved by the FDA. They also have an FDA-approved drug-free treatment called Iovera that uses extreme cold to temporarily stop nerves from sending pain signals to the brain. So unlike a traditional ice pack or a hot water bag that we tend to use at home, this treatment helps with pain relief immediately after the treatment, and the relief can last up to 3 months as the nerve regenerates over time. So pretty intense in some sense if it's basically, putting the nerve out of action for several months. Pacira is Doma's largest position, representing nearly 20% of their portfolio, and they own a nearly 7% stake in the company. We came across Pacira in August 2024 when we saw a cluster of insiders, including 4 directors and a CEO, buy shares of the company.
So when the news of this activist rumor came out, we checked out the company once more, and I noticed, didn't we add it to our watch list about a year ago?
Yeah, you and I review Form 4 filings every night. And when we did that, I think we came across Pacira and I added it to my internal watch list and included a very brief note that said, lots of free cash flow, trading at less than 5 times FCF, or free cash flow, if you will, and revenue has flatlined. I should have continued to follow up on the company's progress as it ended up doing very well with the stock up more than 100% since that cluster insider purchase. Revenue growth, however, remains muted because some of these products that they have were approved by the FDA many years ago, in some instance, well over a decade ago. But the company has been generating free cash flow that exceeds net income. The stock is undeniably cheap, trading at less than 8 times free cash flow, but the slow revenue growth implies that their products are making very slow inroads in a saturated pain management market.
So a short but effective note, to say the least.
Indeed.
So we'll wrap up this podcast with a look at C-suite transition. Now, as the resident avocado lover on this podcast, I felt like it was at least worth mentioning that the avocado producer Caliber Growers saw its president and chief executive officer, Lee Cole, announce his retirement, effective at the start of December of this year. We last talked about Caliber Growers on this podcast in the context of a potential deal that was developing. In June, the company reviewed a non-binding proposal to acquire the business for $32 per share. Prior to this, we had discussed a very small $25 million buyback Calivo had announced in March of this year, representing about 6% of its market cap at announcement. We also see insiders purchase shares of the company from time to time. The most recent purchases were from April of this year. Now, this week it was announced that Calivo was finally exploring a potential sale. It's unclear whether or not they will take that $32 per share bid, if that bid still exists, and who the bidder was. But they seem to be a little bit more open to a sale process. And at the same time, it seems like their chief executive officer and CEO is stepping down. So perhaps that management transition is what is fueling this change.
Indeed, I thought you only wanted to talk about this because you love avocados so much, but clearly there's so much going on here in terms of special situations, all the way from management changes to bids for the company to insider buying. So it's fascinating. Generally, I try to avoid food producers or even food sellers because margins are usually quite low and they don't grow very fast. But this one is interesting.
What's interesting is Calivo Growers hasn't done a lot over the last year. The stock is actually down. But another food business that we pay attention to from time to time is Cal-Maine Foods, the egg producer, which again is about flat over the last year, but in the last 5 years has seen its stock more than double. That was more of a macro or industry condition. Bird flu led to egg prices rising, and then Cal-Maine profited rather than the other way around. So I think there are very, very specific situations where we do find ourselves interested by food companies. In the case of Calvo, it just has to do with all the special situations activity we see at the company all the time.
Absolutely.
And that wraps up episode 45 of the Special Situations Report. What we covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as merger arbitrage tool. Check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data discussed on this podcast. Nothing provided in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions. Thank you.